Let me now bring on board Dinesh Thakkar, Chairman and Managing Director of Angel Broking. Dinesh, what a delight to have you back on ET Now. It's been a while. Dinesh, characterize the market environment for us. One side you've got wall of liquidity and Indian markets are getting about $200 million on a daily basis. The other side you've got mounting fundamental and now political concerns. Which to your mind will have a greater say, global liquidity or mounting concerns?
Still, Nikunj, we have to see in terms of fundamental also market is like well poised. If you look at future outlook, it appears that main concern for this market was inflation and interest rate cycle, which has turned favorable. I think overall, apart from other political issues and events that we have in front of us, markets will always look at corporate earning growth and how interest rate cycles are going to pan out from here. I think looking at inflation numbers, which is coming out month on month, it is quite favorable. It appears that we are almost on the verge of interest rate cycle coming down, which will give a boost to economy as well as corporate earning growth. That would be the main factor which will attract liquidity to the market. So combine good liquidity and good overall outlook, I think we are poised for a good market rally from here.
Dinesh, next 2 days, because the market is going to be extremely heavy and volatile by way of news flow, what is it that you would actually recommend to the retail participants? Watch the news but lay off the market and then take a call Monday onwards once the policy as well as the budget is done with?
See, definitely it would make sense to look at a policy and then take the decision. But if you look at overall scenario, expectation from this budget is very, very low. I don't think that this time there are any high expectation from this budget, given the political equation as well as high fiscal deficit. So if at all, look at the scenario, if at all government is able to give small relief in terms of guiding on fiscal prudence by raising some taxes, definitely we are expecting excise and service tax to be raised from 10 to 12% and giving some kind of an reassurance of implementation of DTC in FY14. And if at all some announcement on, removal of MAT on SEZ comes and roadmap on, mining reforms. So I think this market will take it very positively. So I don't think looking at fundamental and valuations right now, investors should wait and take a decision after budget. I think it would be advisable for investor to take at least 50% exposure, whatever investments want to do, 50% right now, and 50% definitely can wait if he gets a good reaction of around 5 to 7%.
Dinesh, are you a bit worried about how politically things are moved, and especially the equation between Congress and TMC now is looking slightly sour?
I don't think there is anything new in terms of whatever we are seeing, and we know that Mamata Banerjee always wanted to be a bit populist, and in fact whatever we saw yesterday during railway budget was a bit of a surprise. So I don't think market was expecting any kind of a reformist budget yesterday. So I don't think in price that reformist budget was factored in. So in that sense, I feel that looking at as a political scenario, I don't think there is any threat at center to this government, but definitely government is constrained in terms of announcing reforms and reducing subsidies. But anyway, as I told, that market is not expecting any kind of a reformist budget.
3 things if you hear from Finance Minister tomorrow as an investor, as the CMD of Angel Stockbroking, they will make you nervous.
First of all, as I told, that expectations are very low. I am not expecting anything negative, and we have seen that this government has been in power for last 7-8 years. It has not done anything which would be really termed as which will make market nervous. Having said this, maybe if at all this budget proves to be very populist and they don't give a proper care to fiscal prudence, and they increase corporate tax and all that, that will spook the market, but actually that is a very remote kind of a scenario. If you look at previous budgets also, we have seen with say small kind of a negative announcement, market has got nervous when there was a huge leverage position built. But this time if you look around, there is very less leverage position which has been built on expectation of this budget. So I'm not expecting any kind of a nervousness in market because of any small announcements here and there. There can be impact on sectors, yes, but overall market, I do not think there will be any announcement which can make market very nervous.
Dinesh, since you're working with the assumption that, the finance minister will have to hike rates this time around, or rather hike taxes this time around to augment revenues, what is your expectation from the oil and gas pack, considering, crude oil prices internationally are only escalating? You think a fuel price hike is something which is inevitable?
Right, but if you look at, say, this space, even though, first of all, we are not expecting oil price to be really going up from here, given the global scenario where actually I don't think oil will be absorbed beyond this price. And we have seen scenarios where actually oil has raised from 35 to around $100 per barrel, and we have absorbed that. But this time around, I think because of, growth in terms of global concern, this oil will remain in this range, and that I think we are comfortable with. Now, if you want to ride this oil rally, if at all there is any scope, we are not very comfortable in this space because two players one which is more ONGC influenced by government policy decision, and plus whatever new investment they have made have not increased their production. We would not be very comfortable investing in ONGC. Plus Kane India, because of say merger issue, we would like to wait for significant decline to enter into that stock.
So Dinesh, give us one large cap name and one mid cap name where you're confident of a 25% price appreciation in next 1 year. So where you're confident that if you put in 100 rupees after 1 year, you will get 125 back.
Nikunj, I will give you a few more than two. See, we are very confident in terms of banking stock. Already we have been very vocal on Axis Bank. We feel that this is the stock which can give at least an appreciation of around 25 to 30% in a year's time. And now looking at say cyclical rate sensitive sector, we feel that this sector will benefit because of interest rate cycle going down. And in that space, we like capital goods, and company that we would like to bet would be Crompton Greaves. And apart from this, we like United Phosphorus, which always is our favorite. We like scripts like Jagran Prakashan. So overall, I think if you look at market also, it has a potential to give an appreciation of around 18 to 20% for this fiscal year. Looking at benign interest rate cycle that we'll witness, and plus GDP growth that we're expecting around 7.5 for next fiscal year. So looking at this, I feel that corporate earning would grow at around 15 to 16%. On the back of this, I think there's a good potential for market to give an appreciation of 17 to 18% for this fiscal year.
Right. So Dinesh, for Axis Bank, I fully understand there is a structural story. India is still very underpenetrated, and if Indian economy is growing, yes, your financial sector or financial businesses will grow. But the odd ones out are A, Crompton Greaves, and B, United Phosphorus. For Crompton Greaves, there is a problem when it comes to order book. For United Phosphorus, if I look at the recent management commentary, they've cut their annual guidance by about 15%. What makes you bullish on Crompton Greaves and UPhos?
First of all, as I told that Crompton Greaves had faced this order book position because of low GDP growth. We have seen in capital good industry, when GDP grows, decelerates by around, say, 10% also, their order book tends to decrease. But even a slight increase in GDP growth, say from 7 to 7.5, is going to give a good growth to this company. And if you look at, right now, valuation of this company, it is based on lower EPS. And when this GDP cycle is going to improve, I think we will see a better margin for this company. So yet, I don't think all these things have been factored in price. So there is a good room of appreciation for this company. Now coming on United Phosphorus, I think this guidance was only for 1 quarter. But if you look at the performance for previous 4-5 quarters, they have performed well. And this is a leader in this industry. So we should not be getting influenced by, a guidance for a quarter or two. If you're looking for a company, we have to look at 2 or 3 years horizon. And if you look at promoters holding, they have been gradually increasing their holding. So I don't think anything is wrong in this company in terms of medium to long term. Maybe short term there can be a concern.
But net, do you think Indian markets are headed higher? We have already appreciated by about 15% this year. Do you think by the end of the year, Indian markets could add another 10%?
Yeah, by the end of this calendar, you are saying. Nikunj?
Yeah, when I say end of the year, I'm talking about FY3 financial year.
Okay. See, if you look at this rally, it was based on fundamental, and already if you look at valuation, still it is lower by around 18 to 20% if we take historical valuation that India gets. So in that terms, actually, I don't feel that we have formed a proper base. So in that terms, I think that looking at, say, future outlook in terms of interest rate coming down and corporate earning growth would be better than what we saw last year, I think India deserves a PE of around 15 times. So if I take 15 times, and if I take EPS for Sensex would be around, for FY13 would be around 1300. So easily I think a room where a market can be at the level of 19,500 by this year end. So in that context, I feel that there is an enough room. So we should not be worried about a recent rally. I think we were undervalued, and now because of, say, benign liquidity and good outlook, we have come to a proper base, but still there is a room for appreciation so that market comes to 15 P. And looking at, say, corporate earning growth for next year to the tune of around 15-16%, there is a room of further 15-16% appreciation from that level too.